Hey everyone, it's Noah Miller here from Royal LePage Benchmark, mycalgaryhomerealty.com. I'm with Jodi Schulz, mortgage broker from Source Mortgage. I thought I'd bring Jodi on today and do a little video for my sphere and my clients and just get a little insight into what's happening in terms of mortgage rates. The Bank of Canada increased their overnight rate last week by 100 basis points, which effectively means a 1 percentage point increase on the overnight rate. Now, I brought Jodi in for the most important question here, and she can say
hey,
hello.
Noah. Hi, everybody. Thanks for having me on today.
So what is the Bank of Canada overnight rate going up by 100 basis points? What does that mean for mortgages and lenders and people looking to get a property in the future?
Yeah, it's a really good question, Noah. So basically, the rates have gone up. 100 basis points means 1%. So the Bank of Canada's current prime rate prior to that increase was 3.7%, and now it's gone up to 4.7%. Mainly, they have not really increased rates in terms of what we're seeing offered fixed or the variable discount. So by that, I mean like lenders, for example, were offering prime -1 on an insured mortgage prior to that increase. We can still get that prime -1 discount. What's changed is the prime rate, which is set by the Bank of Canada. So instead of it being 3.7, it's now 4.7, which means effectively that the client's rate that they're paying is going to be, on that example of prime -1, 3.7 today instead of 2.7, what it was, say, 2 weeks ago. Now, of course, that has a couple impacts for our clients, our buyers, or people that have mortgages. Number one is that if they're on a adjustable rate mortgage and that rate has gone up, their payments are going to increase because of the interest rate going up. On average, we're saying that for every $100,000 that a client has borrowed or exposure of mortgage exposure, their payment is going to go up about $55. So just depending how large their mortgage is and how much they have there, that's how much approximately their payments are going to go up. In terms of fixed rates, though, nothing has really changed there. And in fact, we're seeing some lenders coming down on their fixed rates because they've sold a lot of variable mortgage products over the last 6 to 8 months. And they're wanting a little bit more clients to go into that fixed rate product. And I think a fixed rate is becoming a little bit more attractive for borrowers who are seeing the rapid increase in the variables. Like we've gone up, the last increase was 75 basis points, so 0.75. And then the current one, of course, last week at 1%. So people are a little stressed, but I think what we need to remember is that when we were qualifying people for these mortgages, they were qualifying always at what we called the benchmark rate, which was 5.25%. So even with this most recent increase, the variable rate borrowers, for the most part, have still not reached that 5.25%. Their interest rates are still lower than that. And so there is some flexibility still there in terms of their max affordability. So I think people just need to put it in perspective. Historically, a variable rate is a great option and does save clients more money. And we're just seeing that that increase happening now, which likely will, come down in the next year or so.
Okay, so Bank of Canada increases their overnight rate, which affects the big five banks and all the banks' prime rate. So prime rate's going from 3.7 to 4.7, and all variable rate mortgages are based off of banks or lenders' prime rate. Is that right?
Yeah.
Okay. So going forward, I mean, 100 basis points is historically, that's a big jump that Bank of Canada made for their overnight rate.
Yeah, absolutely.
What was happening prior? Like, were actuarial scientists and the economists that work for these banks, were they anticipating this? And then why didn't we see the 5-year fixed rate also jump 100 basis points instantaneously?
Yeah, it's a good question. Like I said, the rates haven't really changed, in terms of the discounts being offered and the rates happening. Why it happened, I'm no economist, so I don't want to start, playing in a sandbox that doesn't belong to me. But The reason for the rate hikes is to control inflation. So as they're increasing the rates, they're hoping that that's going to curb spending and help kind of control some of the inflation that we're seeing going on. Once that's under control, we're going to start seeing those rates stabilize is the short of it. Why they're not increasing the fixed rates proportionally, that's something internally with the lenders that they're deciding to do. They must feel that risk wise, they're still getting enough return with what the fixed are being offered. And to put it in perspective, like the fixed rates are still on the high end of what I've seen. I've been a broker for 11 years now. The fixed rates are still sort of on that high end. Like I would say that a normal range is somewhere around 3 to 3.5% on the fixed side, and we're sitting more like 4.5 to 5.5%, depending on the type of mortgage that the client's in. So I think the banks are still getting a very good return on those fixed rate mortgages, and at this point don't see the need to increase them, and in fact are actually decreasing them. We're seeing lots of promotions happening for fixed rate products. And like, I think it's just their mix of business is highly concentrated over the last year in variable rates. And now they're just trying to encourage a little bit more business coming into that fixed rate product.
I see. So they were selling a high number of variable rate mortgages, especially considering that the bank's prime rate was so low. So there were a lot of people going into variable. And so now they're trying to incentivize people buying fixed rate just to map those buckets were uneven in there.
That's exactly right. Like they like to have a mix of both products just for their own risk and that kind of thing. And so they're trying to encourage a little bit more movement into the fixed rate product, which I don't think is a bad choice. I personally still think the variable option is still a pretty decent way to go, but that is going to depend upon the client's tolerance for risk and where they're sitting budget wise and what their affordability is, if they can afford to see that payment to go up a little bit or not, because it is a little bit volatile right now for sure.
Yeah, so there's still lots of upside to that variable rate, and even if there's going to be, say, even we get another 100 basis point increase over the next 6 months with the Bank of Canada overnight rate, say, that variable rate will be typically right now. Variable rate is what, like prime -1 or something like that.
Yeah, let's call it prime -1 for most insured people. So that's sitting at 3.7 right now. So even if we are to see that prime go up to another 100 basis points, they're sitting at 4.7. Whereas the best fixed rate, and again, it depends across lenders, but we've got a couple good promotions that are like 4.58, sitting in that 4.6 range. So you're pretty comparable to your lowest fixed rate. Now the thing is with the variable, yes, we likely, like you had mentioned, what are we going to see happening? No one has a crystal ball, but I do think that likely we're going to see some more increases over the next 6 to 12 months while they try to kind of control inflation. And then at some point that has to end and start coming back down. So if you're on a variable, the nice thing is that, yes, we might get that high, but then as we start to come down, your rate's going to come down, your payment's going to come down. Whereas if you are to lock into a fixed today because you're worried, that's that. Like you're stuck on that rate for the next however long you've chosen it. So let's call it 5 years. So if we see rates in 12 months coming back down to that more standard 3%, it's too bad for you. If you want to get out of that mortgage, you're going to be paying probably a fairly decent penalty to do so. Whereas the variable product, even if you needed to get out of the mortgage, if you needed to sell it or you wanted to refinance it, you only ever pay a 3-month interest penalty. And so it's a lot less restrictive for people. It's a lot less restrictive.
Yeah, and that's one of my favorite things about the variable rate mortgage is people that have a little bit of unknown and job uncertainty. Maybe they have the possibility to get transferred, or life happens and they need to sell, and they're in a fixed rate. They've got a quite a substantial payout penalty if they're going to move. But there might be some portability in fixed rate mortgages, whereas in variable rate there isn't. But the payout penalty is going to be way less if they've got a
that's right.
mortgage.
Yeah, that's right. The payout penalty is only ever 3-month interest on a variable, and so I think that's another reason it's pretty attractive to stay on a variable. Again, it's really client dependent, but my advice to people on a variable is try not to panic. Try not to panic when you see these rates going up. maybe try to put some extra cushion in your budget, in your household budget, to accommodate for potential increases here. Like I said, every 1% is about, say, $55 a month per 100,000. And just ride the wave, because it is going to go up and it will come back down again. That would be the prediction that I think most brokers are saying there. And you don't want to panic and lock your variable into a fixed when we're at such a high fixed, because then you can't get out of it, and then we're facing higher penalties, and you can't come down when the rates come down.
Okay, awesome. I have some more questions. This is like,
Yeah.
I love this conversation because it's enlightening and gives like really good information. Again, I'm with Jodi Schulz of Source Mortgage. I'm curious to know, and if you could touch on the metric a little bit more, for every $100,000 that a purchaser, a home purchaser, a property purchaser wants to finance, what does that cost per month in their mortgage payment? Just because you were touching on that a little bit there.
Yeah, roughly. I mean, like your principal and interest payment for every 100,000 is going to be like, depends on if you're on a fixed or a variable, but let's call it $500 a month approximately for every 100,000 that you borrow. And so again, if you're on a variable, as that rate's going up, and it's not quite 500, that's sort of my average between fixed and variable, right?
Yeah.
But you know, if you're on that variable rate, if the rate is to go up 1%, which is a huge increase, like it's almost historically high, that's not what's normal, then you're talking about an extra, say $50 a month for every 100,000 that you've borrowed. So
okay, so someone in Calgary trying to get into a detached home that's $600,000, they're looking at a $3,000 mortgage payment. If it's a $600,000 you know, being lent, you know, say it would be a $640,000 house, and 600,000 of it they're looking for financing on. That's $3,000, right? So
yeah, exactly.
Okay.
Yeah.
Okay, great. So for people that are thinking about, you know, getting into another property here or buying their first property, Canada is known worldwide as having really stringent qualifying requirements to get into a mortgage. And that's, you know, that's tough on people that want to get in sometimes, but also it's to protect our economy, because what we saw in 2007, 2008 in the US with the subprime mortgage lending meltdown, I mean, it wiped out companies and bankrupted a lot of people. So for people looking at getting in, what do these stringent requirements mean for them in terms of getting either a pre-approval, refinanced, or renewing their mortgages?
Yeah, it's a really good question. So I think it was back in 2016, or in that range, 2016, 2018, we saw a lot of different changes to mortgage rules in Canada, and one of them being the stress test that was brought in, the famous stress test that I think people know. Now, everybody who purchases a home or refinances, or whatever the case is, when you're getting a mortgage, you have to go through the stress test, which means that you have to qualify at whatever the interest rate is that you're being offered, add 2%. So for the longest time, that add 2%, or it was benchmark, which was what was set by the Bank of Canada, which has been 5.25% for some time here. Now with these rising interest rates, both fixed and variable, what we're seeing is that does highly impact somebody's qualification. For example, if they're on a variable rate that's prime -1, so that's 3.7, that means the stress test would have to qualify them at 5.7, so that's plus 2%. Instead of prior to last week, we were qualifying them at 5.25. And so how does that impact somebody's affordability? It can be significant depending on how much of a mortgage they're looking to borrow. I'm seeing on average for most people, it can be, I know we did a scenario for actually you the other day, and I think it can vary, but about 70,000 in some cases. So it's really important to know, because if you've been out looking for a property, say back since April, and you had qualified at the 5.25, that no longer applies to you. So you want to probably check in with your bank, your mortgage broker, whoever did issue that pre-approval, and make sure that you're still qualified for that price range that you've been looking in. Because again, in some cases, it's knocking people down 50,000, 70,000, 90,000 in their purchasing power. And it's just to know, you don't want to be out there and find that home that you love and then realize that, geez, I got to come up with a way higher down payment or whatever the case is to get into that property. That said, I don't want to panic anybody. I think there's always a way to solve these issues. It might mean rearranging things a little bit, paying off a little bit of debt, maybe again, increasing the down payment a little bit, maybe looking at a variable rate because the variable is easier to qualify for still since it is a lower option than the fixed. But definitely checking in with your mortgage provider, whether that's your bank or your mortgage broker, and just seeing where you sit now with these changes would be really wise. There's never a cost or obligation to doing any kind of a pre-approval. And so more than ever, I think it's super important that borrowers, regardless of how serious you are about buying, selling, whatever the case is, do speak to your mortgage professional and make sure you are getting that rate hold. Because if you do that rate hold, you're also locking in how you're qualifying. So even if we see additional increases in whatever the Bank of Canada is doing, you're still locked in at whatever we qualified you for today. And that lock-in is good for 4 months. So you do have a fair amount of time there while you're kind of out shopping to figure it out. Again, no cost or obligation. If things change, we just either renew it or cancel it when that 4 month is up for renewal.
Okay, yeah, I'd be remiss if I didn't ask a little bit about your business and what you can do for people. Now, you do deal with two of the big 5 banks you have direct links with, correct? That's TD and Bank of Nova Scotia.
Yeah, Scotia, yeah, and ATB as well.
And ATB, yeah. Okay, that's great. And then, but on top of that, when people are going to renew their mortgage, say they've been in their house for 5 years, there's no obligation that they stick with that previous lender. They can shop around again, right?
Absolutely, yeah, and it would be advisable to do so because generally your bank or even your other, whoever is lending your mortgage, they don't offer you the best rate generally when they offer you that renewal. They they're in the business to make money too. So it's definitely advisable to get that renewal offer and then call a mortgage broker and see if we can't find a better offer elsewhere, because it costs you nothing to renew your mortgage. You don't have to pay any legal fees or any sort of fee to switch your mortgage to a new provider. And it can save thousands if we're able to get a better rate with a different lender.
Yeah, so shopping around on renewal is really important. And even for people that are just looking for property and gonna be starting financing on a property because of a purchase, you don't even, you deal with, like, there's companies, financial companies that only deal in mortgages, and that's where the power of a mortgage broker is. And can you just talk about who you're affiliated with and how that works?
Yeah, for sure, Noah. So our brokerage is a franchise of Dominion Lending Center. So we're the largest in Canada. What that means is we have access to the most lenders. So we probably have about 60 lenders in our portfolio. Like you mentioned, we do deal with 3 major banks, so TD, Scotia, and ATB. But we also have a whole host of what's called monoline lenders. So what those are is mortgage only. They don't do anything else. So they don't offer lines of credit, credit cards, bank accounts, nothing. They just do mortgages, and they do them really, really well. Some of these lenders that people may have heard of would be like First National Financial, Merrick's Financial, RMG Mortgages, Radius Financial, CMLS. There's a whole host of them. The benefit to a borrower of a monoline lender is sort of multifaceted. Like, first, they tend to offer better interest rates, and the reason being that they don't have like a bricks and mortar location like our banks have, which has an overhead associated with it because they have to staff it and pay rent and utilities or whatever the case is. So because they save that sort of cost in their business, they pass that savings along to the clients, which results in lower interest rates. So that's number one. Number two is they tend to have way less restrictions. So that can come with, can I port my mortgage? What are my prepayment options like? Like, can I put extra money down without paying fees there? And probably the most important is the penalties. So a penalty with a big bank can be substantial because the way in which they calculate that is different than the way in which a monoline lender calculates that. And I actually did an example. I know I shared that with your group with one of my agents. I have a mortgage with First National. She has a mortgage with TD. Both same balance, same everything. Her payout penalty was $30,000 and mine was $3,000. So just those sort of flexibilities. You know, you don't want to be held captive by your bank. It's the worst thing, because if you need to sell for whatever reason and now you're facing a huge penalty that eats up your equity. So that's a reason to choose a monoline. As mortgage brokers, we're totally unbiased. So the way in which we're compensated for doing the mortgage is the same, regardless of which lender we bring the mortgage to. And in doing so, we're giving completely unbiased advice to our client. If our client really wants to work with the big banks, then absolutely we place that mortgage there. But we do it with letting them know what sort of restrictions may or may not come with that, and also the interest rates that are offered with those banks versus maybe some of our other monoline mortgage holders.
Yeah, I mean, in the real estate on the front customer facing side that I'm dealing with, I come across a lot of clients that want to keep all of their financial products all under one house. So they're like, I deal with Royal Bank. I have my credit cards, line of credit. I've got my checking, my saving, my investing, my TFSA, RESP. I got everything there. I want to keep everything there. And because they have this perception that it'll just be easier to set up. But if we have clients that go with one of these monoline lenders, all it is a void check and it's ready to go, right? Like once they get going.
Yeah, absolutely. And I'm glad you brought that up, because that does tend to be a common one where they're like, well, I can't have a bank account with First National. We don't need to. They just will automatically debit whatever bank that you're with. And I also get the question, some people haven't heard of these lenders and they're like, are these Mickey Mouse lenders? Like, what's going on here? Just to clarify, like, these monoline lenders fund billions of dollars of mortgages in Canada a year. So absolutely, they are big players in the mortgage industry. And in fact, I think more and more people are seeing the benefit of, you know, going that direction because of the lower rates and because of the least restrictions that they offer. It's a really good option. And again, we didn't touch on this, but working with a mortgage broker like myself or anybody from my organization costs the client absolutely nothing. Our services are completely free. The banks pay our fees by way of sort of giving us a commission for doing all the work and bringing the mortgage to them, where they make interest off of it. So there's really no reason to not call a mortgage broker if you're looking to purchase or renew or whatever the case is, and at least get some quotes and opinions, because we are licensed by RECA, just like you guys are. Real estate, we're governed by the same bodies. We're required to get a license, and we know what we're talking about. We know lots of the ins and outs of mortgages, whether it's with banks or other lenders, and can give that unbiased advice that clients need.
Yeah, and these other lenders that you work with, like Street, Merrick's, RMG, and all that, they're A lenders. They're not Mickey Mouse. It's not B lenders. I mean, some of them. I mean, we're not going to touch on A or B lenders, but these are A lenders. They're not anything less than that, right?
Yeah, they're very much A lenders. And in fact, a lot of them are funded by the banks. Like First National, for example, is funded by TD.
So it's like are they, is it an arm of TD, or is it TD is considered an investor of them, or are they just partners?
That's right. Yeah, like the money that TD Bank has is funding First National mortgages. So the money that they get to close their mortgages in large part comes from TD Bank.
Okay, amazing. So how can people get in touch with you?
You know, anyway, we're very available. That's another benefit of brokers. We're 24/7. I think you can attest to that. So text, call, email. Our website is www.sourcemortgage.ca. There you can find all of our agents. We've got a couple in Calgary, as well as we have a branch in Sylvan Lake. So we do mortgages all over Canada. Doesn't matter. All of it can be done remotely online, or we can certainly offer in-person appointments or Zoom meetings to people who prefer that. But yeah, it's literally, I think we're quite responsive. I'm sure, again, you can probably attest to that. So if they want to reach out, they can probably expect a reply within an hour. Generally doing like a pre-approval, for example, we can do same day. We're pretty quick. We try to pride ourselves on being quick with turnaround, because we know how urgent some of these things can be when people are looking to purchase a home or renew or whatever. It's a stressful time. We try to take the stress out of it.
For sure. Okay, Jodi Schulz from sourcemortgage.ca, and they can go on there and get all your additional contact information.
Yeah, thanks so much, Noah. Appreciate it.
Okay, yeah, thank you. I really appreciate your time, and yeah, thanks for everything. just can't say enough. It's really enlightening and helps get an idea of what's happening out there, and also how the mortgage brokerage works in terms of helping out people that want to get into real estate or renew.
Yeah, no, for sure. I really appreciate it. And, you know, anytime, like I said, it's no cost obligation. If someone just wants to pick up the phone and have a conversation, ask them questions, like they're worried about rates and whatnot, like we're happy to take your calls. So reach out anytime, and we're happy to help in any way that we can.
Yep. Evenings, weekends.
Yeah, all the time.
Okay. Yeah, awesome. Okay.
Yeah.
Hey, thanks so much, Jodi.
Yeah, thanks. Take care.
Okay. Bye.
Bye.